Hi folks, this is RAJAT Bose from Kolkata. Hi friends, last week we promised that we would actually discuss in detail as to how you would ensure your longevity. While ensuring your longevity, what I actually meant was protecting your capital. That's why I also talked about Buffett's rule of don't lose money, and he had a corollary to that, that is the rule number 2, that is don't forget rule number 1. Now, in order to do so, what you need to understand is this, that if you are investing in the market, first thing that you must ensure is that you are going to be there in the market for a very long time. And if you have to be in the market for a very long time and making money by buying stocks, then you need to follow certain rules. What are those rules? Those rules, first one is that the company that you would be buying must be managed by vigilant leaders. That means the chief executive of the company must be very good and especially would have the ability to allocate capital properly and also manage the capital structure, that is how much equity, how much debt, all this, those things, as well as how to control costs. All of these decisions the CEO and his deputies must be doing it correctly. And one of the thing is this, that the company must have a long-term durable competitive advantage. When I talk of durable competitive advantage, what Buffett meant here is that he talked about durable moat or durable competitive advantage. That is, the company must be doing something by which it has a particular ability to actually sell its goods or services in a manner that others are not being able to match it so easily. So that actually gives pricing power. Say when an investor is looking for a company that would actually have pricing power, that company must have something unique, something so durable in terms of the special advantage that the company enjoys, that it can actually come up with pricing power, come up with say access to customers and all this. And for us to understand, for us to go for such a company, this company you should actually get something like a very stable company and it is understandable. When I say understandable, let me give you an example. Say you are talking of a company like Nestle or Hindustan Lever or ITC. You know these companies very well because Nestle is in the FMCG space, so are ITC or say Hindustan Lever. We have a fair amount of idea, and certain things is that that these companies are easily understandable because they have businesses that the products or services that they produce, especially in this case the 3 names that I mentioned, they offer such products that most of us almost on a regular basis use them. And also we also see pricing power in them. I'll just give you an example. Say Maggi noodles, the chicken Maggi noodles was about a year back, it was being sold by Nestle at 12 rupees a pack, and now the same chicken Maggi noodles for 70 grams is being sold for 18 rupees. That is a 50% rise in the price. Now this 50% rise in the price has been possible, and you will be astonished to see that Maggi sales have not come down. The chicken Maggi is still very popular. So similarly, think about Hindustan Lever and its products. It it also has the pricing power. I'm not saying that say Lever, ITC or Nestle's are the only companies that you would be buying, or you will be only looking at FMCG companies or something like that. But only thing that you have to be clear is that suppose you choose a company whose business you don't understand at all, it would be very difficult for you to really go for that kind of a company, because then you are actually relying on somebody else. What kind of company is that, and how is it doing business, how is it making money? But here at least you have an understanding of its products, and now to understand the ability of its distribution channels, you will see that whether the company's products are easily available. When you want to buy it, it is available, and it is available on various platforms, like from your common neighborhood grocery shop or kirana store to say on online platforms, that kind of thing. But it should be an understandable business. It should be a business that you can really relate to, and it should be a business that is stable. Why stable? When I say stable, unless you are actually going for a stable business, you would not be able to forecast its cash flows, forecast its earnings, because if a company is not stable, then what happens? You will not be able to project its sales, you will not be able to project its margins, you will not be able to project its cash flows. Then it would be very difficult for you to actually understand whether the price you are paying is actually much higher than its value or much lower than its value. You don't have a basic understanding. To form a basic understanding, you need to actually look at those kind of companies that gives you this kind of stability in their earnings, in their sales, in their performance. Unless you go for such kind of a thing, all you would be doing is that you will be investing in somebody else's recommendation or somebody else's tips. That would not give you the kind of advantage, the kind of safety that you are looking for. Now we are going to discuss one of the most important things for you to be successful as an investor, and this is what Benjamin Graham called as margin of safety. Warren Buffett used it, Charlie Munger also liked it, and Seth Klarman wrote a book on this. What is margin of safety? How does it come? Margin of safety actually is that you are, when you are entering into in a stock and you are buying it in the market, you are buying it as an undervalued stock. That means whatever it is worth, you are actually paying a price that is lower than that. I'll give you an example, perhaps an extreme example. Think about March 2020. A number of stocks, or rather most of the stocks in the market at that point of time, late March 2020, that was real bargain prices. Although there was blood on the street and people were so cut up that what will happen. In fact, most of the people were thinking that they are actually going to lose in a big way. What will happen in the stock market? If any of you or other investors, savvy investors who have mustered courage and bought stocks around that time, they have bought stocks at a very undervalued levels, and the price that they paid, that was much lower than the value that they were getting. Here I must actually clear one misconception. What is that? Lot of people who actually claim themselves to be growth investors, and especially those who invest in technology stocks or pharma stocks, those companies that actually posts very high earnings over a period of time, say maybe 2-3 years or so. These people have this notion that, say, they may be buying a stock, say a company like Tata LXI, if you are buying at a P level of 72, the growth prospect, the future growth prospects of a company like Tata LXI or some other tech company or a pharmaceutical specialized research company, P multiple is so high, yet people are actually going for that. Why? Because future growth will be such great thing, so it will be so great that all these high valuation will be justified by its future performance, and as they say that if the company is performing well, the stock will also follow. But we are making a mistake here. In Intelligent Investor, Benjamin Graham talked about this. When he talks about margin of safety, he clearly mentioned that you are actually paying a price for a company that is much below its worth, or rather, much below the kind of value that it is generating at that point of time. So you are buying an undervalued stock. So it is a clear price point safety. That is the price that you are paying for that stock. If it is much lower than the value of the stock, then you have that much margin of safety. And when he was asked that what about growth companies and positing very high growth and all that, he simply said one thing. When you are talking of growth, and especially future growth, you are actually entering into the realm of speculation. Why speculation? Because you don't know the future. Tell me something. Whoever thought that in March 2020 there will be a thing called lockdown, there will be a thing called COVID all over the world, and there will be lockdowns all over the world and stuff like that. So this is unfathomable, this is not foreseen. So when you are positing growth, the moment you are going into the realm of future, this is actually entering the reign of speculation, or rather the kingdom of speculation. We are not going to speculate. We are only seeking margin of safety by the price we need to we would pay for acquiring a particular stock. Now you can say one thing. Suppose if we follow this principle that we would only buy when the stock is undervalued, or rather sometimes deeply undervalued, what a lot of people call as deep value stock, that means you won't get that kind of prices not regularly. In fact, you might have to wait for a very long period of time. Now, does this pose a problem? That is, you are only holding cash. Seth Klarman once said that he prefers to keep the cash parked as it is in a bank, so long as he does not get the right kind of opportunities. If that is the case, then you also should cultivate the quality of patience. In fact, Warren Buffett said that stock market is a place where money is transferred from the person who is impatient to the person who is patient. So you have to willingly wait to ensure this margin of safety. Think about it, whether you bought a mediocre stock or you have bought a great stock, if you have paid a very low price or you have paid a price that is much lower than its value, then even if there were to be volatility, you don't bother much. But that elusive growth, whether that will happen, or if the growth actually continues to happen, but it isn't happening at a pace that you thought it would, in that case what you will see, the growth is happening yet the company's stock is not rising, or the company's stock even in the face of growth is actually falling. So we need to follow this margin of safety. I personally feel that this margin of safety concept is the most important concept that we have to keep in mind and cultivate. If you ask me, that I read about an investor whose stock market career in the Wall Street spanned over 70 years. He invested in 1929 and he invested money in 1999 when in the year he died. So he was asked that what is the quality that is the most important quality for an investor. He mentioned patience, and this patience will generate your margin of safety. And if you follow this margin of safety principle, you are basically on your way to making good money going forward. In the year 2000, when there was a heady tech bull run, Warren Buffett actually commented, I remember what he said very clearly, there was, if you pay too high a price for acquiring a stock, you are actually sacrificing several years of growth down the road. What did he mean by that? Suppose if you are buying at a stock at say 70p or 80p, that means for every rupee of its earnings, you are actually paying 80 rupees or 70 rupees or whatever high PE that you paid. That means sometimes you will see these stratospheric PEs of 70 or 80 are actually justified in the market by projecting into the future. That say they won't talk about FY23 earnings, they will talk about FY25, FY26, that is March 31st 2025 or March 31st 2026, and it would be justified as in March 31st 2025 the stock would be available at 25 or 30 PE, which is much more reasonable. But just consider this thing, what you are doing. That means today when you are buying that stock at 80 PE, which you think that would become 30 PE going forward in March 31st 2025, you are basically sacrificing the growth from here, the current date, to 31st March 2025 or 31st March 2026, whichever acceptable PE, whichever year's acceptable PE you are actually projecting. So this means that we are basically deluding ourselves into thinking that this high PE would be justified going forward with much better growth in the future years. Is it an impossibility? No. Definitely there are companies that might actually produce that kind of growth for 3-4 years. But also remember, during the tech boom, people have realized that 300 PE or 200 PE kind of stocks, they felt that they were actually not paying very much, but later periods have shown that they actually overpaid in a big way. Another thing is that there is a saying in English that growth forges its own anchor. That means if you are growing at 50 PE, or if you are going at a rate of 50%, your earnings are growing at a rate of 50%, that means what is today 100 rupees will become 150 rupees the next year, and 225 rupees the second year, third year, and then after that it will be 337. This way you cannot grow. Growth forges its own anchor. And if you talk to an economist, they will say after a certain period of time following the heady growth rate, all companies generally grow at a rate which is more or less a much lower and stable growth rate, and that is not too far away from the GDP growth rate. So always keep this in mind, that if you are paying too high a price, you are sacrificing several years of growth down the road. Investors like Warren Buffett or Seth Klarman or say Benjamin Graham would seek businesses that are growing at a consistent pace and that is generating earnings on a regular basis. What does that mean? Especially they talk about generating money at the operating level. What does that mean? That is the company that is under question, or that is your stock that you are actually planning to buy, should be generating operating level income. What is operating level income? That is your sales minus cost of goods sold, that is the operating level income. And also look at it that whether this operating profit is maintained on a consistent basis, or there is certain amount of growth also happening at the operating profit level, because this operating profit minus the capital expenditure incurred is the free cash flow, and that is divided by number of shares would produce free cash flow per share. This is the most important yardstick that you should keep in mind. Unless the free cash flow is generated by a company, then that company would not really produce, would not really survive or would not really perform on the stock market for a very long time. Maybe in short periods of time through speculation or some other means that stock might go up, but sustainability of staying at a higher level would not be possible if free cash flow is not generated on a consistent basis. So keep this in mind, that operating profit should be consistent and there should be regular free cash flow generation. These are the principles that you need to follow. Of course, this is not an exhaustive list, but this is the basic list of parameters that you need to consider when you are actually looking at a stock for investments, and never confuse margin of safety with high growth rate. We are going to continue with this in the next week. We will come up with elaborations of what are the basic things that I have discussed in today's video. Keep watching, and if you liked what I presented, then please do not forget to press the like button, subscribe to my channel, and also press the bell button so that you get the notifications in due course.